Where are we in this cycle?
Well, we've seen a cycle that, frankly, is different than past cycles. In the depths of the pandemic, demand collapsed at a rate we'd never seen before. And activity contracted because it had to, and there was no demand for incremental production. We were looking for ways to store production that the world really didn't need. And now we've seen the reverse of that, and a dramatic increase in demand, economies that have largely reopened, but not completely yet.
So no sign of demand destruction yet, based on where we've been?
No, quite the opposite. We're still seeing real strength in demand. We're seeing, international air travel is the strongest since before the pandemic. China still has a ways to go. So a lot of signs that demand continues to be very strong. And demand typically in our industry moves faster than supply in both directions. And we saw that in 2020. We're seeing that today.
So in terms of supply, you are working hard in the Permian. Your production is looking to be 17% or 15% increase, right? If I said to you today, pump more, literally, could you?
I couldn't pump more today. The incentives today are to pump as much as you can. And the decisions that lead to today's activity were made 2 years ago. And there are lead times in all of these things. It's land work, it's permitting, it's roads, it's infrastructure, it's drilling rigs, completion crews. There's a lot that goes into planning and executing production growth. Last year was the highest year of production in the history of our company. First quarter this year, we were up 10% versus first quarter a year ago. So we're doing our part to meet this growing demand, but it's not instantaneous. It requires a longer lead time. Even in the shorter cycle portion of our activity, it doesn't happen quickly.
So if we pretend that maybe it could, where's the biggest bottlenecks? Is it sand? Is it labor? Is it wages? Is it transportation? Like, where's the problem?
In the U.S., in particular the Permian Basin, where there's the most activity, it's all of the above. During the pandemic, operators, shut activity down. The companies that support our work had to do the same. Workers left and went to other parts of the country. Rigs were stacked up. Those that were still in the field, when they had maintenance issues, you took parts off of rigs that were in the yard. So all of those things now need to be reversed, and so there are very real constraints. I mentioned earlier, we plan our work and then work our plans. So our plans to continue to grow were laid in place even back during the depths of the pandemic. But to incrementally change that right now, there is a lot of work that has to happen and a lot of constraints that have to be solved for.
Like, it wouldn't matter how many times the stock hit a 52-week high, or it wouldn't matter like what the oil price was, is what you're basically saying. Yeah,
the price of the day doesn't influence our capital decisions and our activity. We have a long-term view on supply, demand, markets, technology, policy, and that's what sets our capital spending. We've been very disciplined with our capital spending. We've laid out a plan to our shareholders that says within a pretty narrow range of capital activity, we can grow cash flow, we can improve returns, and our production will also grow. And so we're on that path, and we've stayed on that path. And executing that with discipline is really important for companies like ours. And so to deviate from that because the price today is higher, the price 2 years ago was low, is really not how we run our business. We see our way through cycles. It's always been a cyclical business, and so we continue to take a longer view on how we set activity.
We'll get to the policy part in just a second, but on costs, I know you've sort of looked at costs and how they're going to increase this year. What's your visibility into next year? Do you have an idea of what your cost inflation profile is going to look like?
We're working on that now, Alex. We're pretty well covered this year because, again, the contracts and all the things that go into our activity were really established, quarters back. As we look to next year, we're working with suppliers. We're looking with the people that supply goods, services, inputs to us. And there is the inflationary pressures that the economy sees are certainly present. We have strategic relationships with a lot of the people that we work with. We didn't bring our activity to zero during the depths of the pandemic. We kept work underway. We have a longer-term contractual relationship. So we have some ways to manage those costs, but clearly the pressures are up across the entire economy, and our industry is no different.
Double digits? Do you know yet?
It's early to say. We're right in our planning process right now, so it could be high single digits, could be low double digits. It varies around the world. Certainly in places like the Permian, where there's a lot of interest and activity, you can feel more pressure than you would in other parts of the world and other types of activity in our business.
Well, let's stay here in the U.S. for just a second. So obviously, it doesn't matter how much oil you guys can really pump, because the real crisis is in the product market, and that's really a refining issue. There are just not as many refiners running as there were 10 years ago to create the product. So on that point, I spoke to Secretary of Commerce Gina Raimondo yesterday, and I said, have you been talking to executives? What's that conversation like in terms of creating more products? And this is what she had to say.
That we can, including, working with the private sector to increase supply of energy sources.
Have you talked with the administration recently?
I've not spoken to the administration recently. I expect that I will. I'll be in Washington next week, and I hope to meet with people there. I've spoken to the administration over the past several months. But you're right about these bottlenecks in refining. We've seen refineries close. When I began my career, there were more than 250 refineries in the U.S. Today, there's half that number. And we've seen refineries close around the world. We've seen China stop exporting products. Obviously, Russia exports have diminished as well. And so many of the sources of product, that normally flow into markets have been constrained. And we're seeing very strong demand, as I mentioned earlier, and that's resulting in a lot of upward pressure on prices.
So if you go and talk to President Biden or the White House next week, what would you want to tell them? Because in essence, no matter what price signals you're getting from the market, the world is moving to phase out the products those refiners would use. That places you in a tough spot.
It puts the industry in a difficult spot because building a refinery is a multi-billion-dollar investment.
Process.
It may take a decade. We haven't had a refinery built in the United States since the 1970s. My personal view is there will never be another refinery built in the United States. But you're looking at committing capital 10 years out that will need decades in which to offer a return to our shareholders in a policy environment where governments around the world are saying we don't want these products to be used in the future. And so there really is a dilemma. We receive mixed signals in these policy discussions, and my message would be we need to sit down and have an honest conversation, a pragmatic and balanced conversation about the relationship between energy and economic prosperity, national security, and environmental protection. We need to recognize that all of those matter, and we can't over-index on just one.
You've been at Chevron for many decades. You were a refining guy. Did you ever think that we'd ever see global refining margins like this and possibly sustainable?
I've not seen margins this strong during my time in our refining business. It's a unique set of circumstances. We're coming out of a once-in-a-century pandemic, very strong economic growth. As I mentioned, some things that have constrained product supply into markets, and it's a set of circumstances that we really haven't seen before. These things never last forever. And markets work. Sometimes it takes time. There's an old adage, the cure for high prices is high prices. And the reason some of these sayings are around is because they're actually true. The price signal suggests producers should produce more, consumers should consume less. And eventually, that dynamic does bring prices back into a lower range.
Do you think we could ever be in a world where we're going to have to ration gasoline? There was reports about potentially that happening on the East Coast. Like, literally, could that actually happen this day and age from where you see it?
Markets are very efficient today, and as long as the infrastructure exists and the ability to supply markets is not constrained by interventions, I think that really diminishes the likelihood that we could have outages. Now, you can have a hurricane, as we saw with Hurricane Rita, Katrina back 15 plus years ago, that can cause localized outages. You can have things like that, but I think if we allow markets to function, markets will get supply to where it's needed. But interventions in markets that are sometimes well-intended can create unintended consequences, and that's where outages, the likelihood could go up.
Mike, over the past few years, you guys have really crushed it when it comes to M&A. Like, you've pulled out of deals at the right time, you bought at the right time. Noble Energy really buying at the bottom of the most recent cycle. What do you see for M&A right now? Like, is Chevron interested in anything? What are valuations like? Give me the Mike perspective.
Well, we're about ready to close a deal I'm really excited about, the acquisition of Renewable Energy Group, which is one of the leading renewable fuels producers in the world. And we have a growing renewable fuels business. They have great expertise in the feedstock arena particularly, but also in the product arena. We have assets and value chains that we can connect. And so this is a deal we hope to close this month, and very excited about that as part of our commitment to new energies, to lower carbon energies. If you look at the Noble transaction, that's worked out very nicely for us. We continue to scan the environment. Typically, deals done in a high price environment have been difficult. It's difficult to find motivation. Sometimes it's difficult to find economics and value. But we're always looking, and we'll be selective in when we act. But it's been part of how we've grown the company over the years, and I would expect us to continue to over time.